Oh. Good afternoon. I'm Dan Heiser, Dean of the Schneider School of Business and Economics at St. Norbert College. I want to welcome you to today's webinar, The Economic Impact of COVID-19, brought to you by our Center for Business and Economic Analysis in partnership with St. Norbert College, Office of Alumni and Parent Relationships. We're glad you're able to join us for today's discussion. Today, we have a presentation which is data-driven commentary on the economic impact of COVID-19. We're planning to drill down on the financial markets and the fuel markets. And in that regard, we are very grateful for the expertise and support of our sponsors, Breakthrough and Wipfli Financial. Our goal for today is to use data to highlight what is actually happening to the economy since the outbreak of COVID-19, rather than referencing speculative forecasts. We're going to be addressing indicators such as unemployment, consumer sentiment, uncertainty, along with financial market volatility, as well as the oil and gas market. But before we formally kick off the content for today's program, I have a few housekeeping items to attend to. If you've pre-registered for the event, you'll receive a short follow-up questionnaire. So please take a moment to provide us with your feedback and suggestions. Your insight will be instrumental in shaping our future programming. Within the questionnaire, you can also request a copy of the presentation decks, and you'll be able to review a recording of today's webinar. Our speakers will present, followed by a Q&A and questions gathered during the registration process. We still encourage you to put your questions into the live stream chat, and we're going to be using those to help us define future events. So today's speakers include Mark Schaefer, Associate Professor of Economics at St. Norbert College and Director of the Center for Business and Economic Analysis, Rafia Hassan, Chief Investment Officer at Wipfli Financial, and Matt Minster, Senior Manager of Applied Knowledge at Breakthrough and a communication graduate from St. Norbert College. Dr. Schaefer completed his undergraduate work at Augustana College in Rock Island, Illinois, and received a PhD in Applied Economics from Western Michigan University. Mark's graduate studies concentrated in monetary economics and econometrics. Prior to a career in academia, Mark worked in finance for both a fund company and an institutional investment manager. Aside from teaching courses in macroeconomics, international finance, and money and banking, Mark conducts research on the behavior of financial intermediaries and their impact on economic activity. He also holds the Dale and Ruth Michaels Endowed Chair here at St. Norbert College. Rafia brings over a decade of industry experience to her role as CIO of Wipfli Financial Advisors, in which she oversees every facet of the firm's investment program and approach. She holds an MBA from Macomb School at the University of Texas, Austin, as well as a Bachelor of Arts degree in Economics and Mathematics from Wellesley College. Rafia is a holder of the right to use the Chartered Financial Analyst designation and is a certified financial planner professional. Matt, in addition to being an alumni of St. Norbert College, he received his master's in economics from Bowling Green State University and his Breakthrough's internal subject matter on international fuel markets. Breakthrough uses patented technology and industry knowledge to create transportation, energy, and supply chain management strategies for the world's leading shippers. Matt applies research, industry data, and understanding of market fundamentals to translate energy industry information to clients in an actionable manner. His specialties lie in the Mexican oil market and maritime shipping industry. St. Norbert College is grateful to each of you for sharing your insights with us today. And without further ado, I'm going to hand it over to Rafia.
All right. Well, thank you so much, Dan, for that introduction. So I wanted to start today with an update on what's happened in the financial markets so far this year. So if we turn to the next slide, it seems hard to believe given where we are today, but 2020 started off as a very strong year for the global stock market. We were coming off of record-setting year in terms of stock returns in 2019. U.S. stocks were up about 30% in 2019. International and emerging market stocks were up 20%. And it wasn't really until the middle of January 2020 that news around COVID-19 in China really started to circulate. So on January 31st, the World Health Organization declared COVID-19 a public health emergency. And even then, the markets dipped a bit, but then came back as many anticipated the disease would be contained within China. The real domestic news within the US at that time that was taking center stage was really around the US election and primaries here. Then we got to the middle of February and the world stock market started to take a hit. It was around this time that the news of the coronavirus spreading beyond China really started to come out. Towards the end of February, the cases in Italy and Iran started to surge and Italy imposed a lockdown. On February 29th, we had the first US death that was announced. I say announced because we're now hearing that the first death may have been earlier than February 29th, but at that time, that was what we knew. What's also interesting when you look at a chart like this, which shows the world stock market overlaid with key market events, is how day-to-day headlines and market movements sometimes don't move the way you might expect them to. From February 28th to March 4th, the world stock market actually bounced up, even though more worrying news about coronavirus spread was coming out. In full disclosure, there are many headlines that came out that aren't on this chart just for readability. So then we get to around March 4th and March 5th and things start to get rough again. Congress passed a coronavirus package, an $8 billion package on March 6th. We had the Super Tuesday primary results where a number of Democratic candidates dropped off the ballot. But then on March 9th, we started to hear more about oil market unrest, which I know Matt is going to cover in a great bit of detail later on. But to give a quick recap, at that point, there was already a slowdown because of what was going on in China. There was depressed demand for oil, but then we heard about Saudi Arabia and Russia not being able to come to a production cut deal. And in fact, Saudi went on the offensive, saying they would flood the market with oil, which caused a great deal of anxiety within the stock market. Then on March 11th, World Health Organization declared a pandemic. Here in the US, we imposed travel restrictions on Europe. And then on March 13th, the president declared a national emergency. It was Friday the 13th, and in a strange turn of events, the acknowledgement of the issue actually seemed to cause the market to bounce up that day. March 13th is a day that I remember well because the S&P 500 was actually going down before the press conference, and it shot up in the very last hour. And March 13th actually went down as one of the top 30 strongest days for the S&P 500 for as long as we have data going back to 1926. That day was the 10th best day for the S&P 500. So interesting turn of events on March 13th. Then March 15th, the Fed cut the federal funds rate to zero and announced quantitative easing of $700 billion. That same day, the CDC advised against events of 50 plus people gathering together. The following week, March 16th, the situation seemed to be getting worse. The White House advised the public to avoid bars and restaurants and suggested to avoid gatherings of 10 plus people. The market continued to go down. Many states imposed shutdowns. And here we're just looking at the stock market, but what you don't see that was also concerning that was happening within financial markets was happening in the bond market. And at that point in time, even high quality bonds were experiencing liquidity issues, essentially meaning that it was difficult to sell these normally very liquid positions in bonds. And on that front, the Federal Reserve kept announcing additional measures to stabilize the credit markets. Many of them were from the same playbook as they used in 2008, 2009. The following week, March 23rd, and March 23rd was, I will call it, the most recent bottom of the market that we've seen in this crisis. That week, liquidity continued to be challenged in the credit market. So on March 23rd, the Fed came out and essentially announced that they would do whatever it would take to stabilize the market. And many of these measures were unprecedented, even for what took place in 2008 and 2009. Record amounts of quantitative easing announced, support of the municipal bond market, and also the Fed talked about providing support to the investment grade bond market as well as the high yield market. Meanwhile, Congress and the Senate were working on a bill to get fiscal stimulus in anticipation of the shutdown's impact on the U.S. economy. Originally, the stimulus package that was proposed was around $1 trillion, but the final number that was passed on March 27th was $2 trillion of stimulus. And the market actually bounced up a few days before that news was announced. With all of those measures, we've seen the market rebound. We saw the market rebound in the last few weeks of the first quarter. What you don't see on this chart, because it only goes through March 31st, is what has happened since March 31st. And that is basically that markets have continued to rally. And in April, we've seen the global stock market up by about 11%. So it was truly what I would call a roller coaster ride in the market in March of 2020. We saw significantly down days, which you would probably expect given what you're seeing. But we also saw some huge up days, which may be less intuitive. And so to give you an idea of just how volatile and uncertain things were in the financial markets, I want to show you on the next slide a chart of a volatility index. So this is a chart that shows the market's expectation of near-term volatility for the S&P 500, which is an index of U.S. large cap stocks, and it's based on options, stock index options for the S&P 500. It is essentially a gauge of uncertainty, or sometimes more dramatically, it's called the fear index. And in most time periods, the index is normal time periods, I would call it. The index is between 15 to 20. The higher it goes, the more uncertainty and expected near-term volatility in the market. And so in March of 2020, this volatility index shot up to 80, and that just indicates how volatile the market was within that time period. The last time we experienced this level of volatility in the market was back in October of 2008 during the financial crisis, when the market was scared that there were going to be runs on banks and the entire financial system was going to collapse. So today, the VIX is back down to closer to 35, which is still an elevated level relative to the norm, but it is a lot lower than that high of 80 that we saw a few weeks ago. All right, so against that backdrop of extreme uncertainty due in large part to coronavirus, let's take a look on the next page at the results across different segments of the financial markets for the first quarter of 2020. So what this chart does is it ranks the different segments of the financial markets in order from best performing asset class to worst performing asset class. Now, the best performing asset class for the first quarter of 2020 was investment grade US bonds. This was in large part because we experienced what we call a flight to safety. Some investors did not want to hold assets with even a modicum of risk and sold out of those investments and instead moved to cash or moved to US Treasury bonds, which are perceived to be kind of the riskless asset that's out there. So investment grade bonds, which hold a significant portion of US Treasuries, were up 3% for the first quarter. Investment grade municipal bonds were pretty much flat, slightly negative for the first quarter. And then high yield bonds, which are also called junk bonds, were down 12%. These bonds are riskier than investment grade or even investment grade municipal bonds. And then emerging market bonds, which are also more risky, were down 13%. Now, stocks, which are riskier than bonds, were down even more. Within stocks, U.S. large cap stocks were down 20% for the quarter. Within international developed and emerging market stocks, performance was slightly worse. So those stocks were down about 23%. And then small cap stocks, small cap U.S. stocks were really the laggard for the first quarter, and they had the toughest time, down 30%. Small cap stocks are generally thought to be more vulnerable to periods of economic distress because they often don't have access to the credit markets and the wherewithal to be able to withstand a downturn, as well as larger stocks. And this is why in the fiscal stimulus, there's specific funds that have been earmarked for small and mid-cap companies. So I spent some time talking already about the stock markets. I want to spend a little bit more time focusing on the fixed income markets and what happened there. So if we turn to the next slide, what we see on the left is the U.S. Treasury yield curve. The yield curve essentially shows us for U.S. Treasury bonds that are maturing at different points in time, what is the interest rate or yield that an investor earns on those bonds. And the reason that the yield curve is important is firstly because it sets the risk-free rate, because U.S. Treasuries are deemed to be risk-free. The U.S. government can essentially print money to pay its obligations. You might have opinions on whether that's good or bad. And the shape of the yield curve tells us also, if you get paid more for holding longer maturity bonds, and it also embeds information about expectations for what future interest rates might be. So on this chart on the left-hand side, we're looking at how the yield curve changed from last year until now. And so the chart in the dark blue, the line in the dark blue on the left-hand side shows the yield curve as of March of 2019. So that's about a year ago. The yield curve was actually inverted partly. So from the 1-year note to the 3-year note part of the curve, you can see 1-year notes were actually yielding slightly more than 3-year notes. And then in December 2019, which the yield curve is shown there depicted in purple, you can see that from March 2019 to December 2019, yields actually went down. And then in gray, you see where we're at today. The line for the yield curve was where we're at today for March 2020. And what you see there is yields went down on all parts of the curve. And especially, what you see is at the shorter end of the curve, yields went down by slightly more. And so now the curve is more upward sloping, meaning you are getting paid as an investor in U.S. Treasuries to take on term risk to hold longer maturity bonds. But overall, investors are getting paid less today in yields for U.S. Treasuries. And the reason for that is that the demand for Treasury bonds went up. So we talked about flight to safety, investors not wanting to have as much risk. And so that riskless asset that we've talked about with U.S. Treasury bonds, the price for those bonds went up. And as bond prices go up, yields go down. And so you see that yields went down on every part of the U.S. Treasury yield curve over the course of the quarter, and also since last year. In other areas of the fixed income markets, we actually saw yields increase. And so you can see that depicted on the chart on the right-hand side, where we're seeing the yields. The very first bar is showing you the yield for the 10-year U.S. Treasury, but then you also see what the yields were for municipal bonds, which is higher than U.S. Treasury yield curves, as well as the yields for corporate bonds, so bonds issued by companies, and various different grades of whether those are high quality bonds or more junk bonds in that double B, single B area of the yield curve. So basically what you're seeing here for fixed income is investors are getting paid more today for investing in these riskier parts of the market because of the uncertainty that is out there today. So now, we've talked about how the first quarter of 2020 was a difficult time for investors. Let's switch gears a bit and talk about the question on many people's minds, which is how long will this period of market distress last? So if we turn to the next slide, we can't make predictions as to how long this particular event will last, but we can look to previous market shocks to provide us a guide. And the chart shows bull and bear markets for the S&P 500 index going back to 1926. You can see from here that there have been 8 bear markets over this time period. The one most fresh in most investors' minds was the great financial crisis of 2008, 2009. That one lasted 16 months. One of the shorter ones that we've seen is the bear market of 1987, which lasted just 3 months. So there can definitely be a range when it comes to time frame. But to me, the biggest takeaway from this chart is that bull markets tend to last longer and provide stronger returns than the bear markets. And that's why many investors will stick it out through these periods of bear markets. And here we're only looking at the S&P 500, but most investors hold bonds in addition to stocks. And bonds tend to provide stability through periods of market troughs, which is why it's so important to have a mix of stocks and bonds within an investor's portfolio. And one final thought that I want to leave everyone with is that while what is happening today is in many ways unprecedented, when you're thinking about the stock market, it's important to remember that the stock market aggregates all of market participants' information and expectations in real time. And the stock market has done this over multiple periods of uncertainty. So while we might zoom in on the last quarter of returns, maintaining perspective is key. So if we turn to the next slide and we zoom out on that chart of world stock market returns and take it back further to say 1970, you can see how COVID-19 is just a blip. We look at the past experiences that investors have had. It's important to caveat that with we don't have a crystal ball to predict what happens next, but we do know from past experiences that the market tends to be a leading indicator of the economy and that the market can take off. The stock market can take off well before economic news turns positive. And we saw this in the last financial crisis of 2008, 2009, where we saw that, that recession officially ended in June of 2009, but it was 3 months after that the stock market had bottomed that the recession officially ended. And same goes for unemployment numbers. Unemployment peaked in October of 2009, and that was 9 months after the stock market bottomed. So the key takeaway is that the stock market tends to be a leading indicator of the economy. And with that, I'll hand it over to Mark to talk more about the data on what's happening in the economy.
Rafia, thank you so much for that overview of what's happening from the financial market perspective. I think your comments at the end segue very nicely into what's happening from the economic standpoint. As Rafia mentioned, and one thing that I think I want to highlight, there's an image floating around of Mad Money on CNBC, and there's an image on the same day they showed the backdrop as the best day in the stock market, but the front line was like massive unemployment claims, suggesting this difference between sort of the leading and the lagging part. And a lot of what we're looking at the economic perspective is a lot of the lagging part. The data we're looking at, we get it with a bit of a delay. So that being said, what I want to focus on is what data do we have now? What can we say about what we already know has happened? And maybe just a couple comments on some things looking forward. So specifically, what I want to focus on is a couple economic indicators to start, a little bit based on policy response. There was a lot of questions that came in about that, and just a couple of comments from a regional perspective of some data that we can look at now. So first up, I feel like I almost have to, as an economist, talk about the number that's showing up on the news on a regular basis now, and that is the initial jobless claims data. That's the number that comes out every Thursday, and every Thursday, you'll see it first thing on the news. Initial claims shot up by some amount. What I'm showing you here is a chart of initial claims, which is the green line, and continuing claims, which is the gray line. The green line is basically saying, here's how many new people filed for unemployment within that given week, and it's week by week. The gray line is basically, in a sense, aggregating some of that initial claim data into it. Now, what I want to stress with this are basically three particular points. The first, in looking at this relative to the financial crisis, you can see the shock here is a little bit more significant in terms of its movement. I recently heard someone describe a lot of our economic charts are basically now going perpendicular because it's such a sudden jump in how it moves. And so that's the first thing, is this shock is pretty sizable compared to what we saw in the financial crisis, especially in terms of the speed of how sudden it went up. The second thing to highlight is the aggregation of this right now. So this is even stale because new data came out this morning. But if you look at just the total initial claims that we've seen since from March 21st through 4/18, about 26 million new claims, another 3.8 million just this morning. So we're basically hovering around about 30 million new initial jobless claims coming in just in the past month and a half, which is obviously significant. To put that in perspective, the third thing I just want to throw out there is sort of what does this mean in terms of broader unemployment? Neither of these measures are the official unemployment numbers. They're just good leading indicators because we have them pretty quickly in terms of how fast we get the data. So as a matter of perspective, in February, the actual level of people unemployed was about 5.7 million people, was the actual number of people that went into the unemployment figure of about 3.5% in February. If you fast forward to March, the number jumped up, in the actual data we have, the number jumped up to about 4.4%, and we had about 7 million people included in that unemployment number. So since that time, we now have, 30 million people have put in for initial jobless claims. Now, not all those people will officially be considered unemployed necessarily, depending on how they end up in the data. But what we can say is the unemployment number is about to pop a significant amount. What that's going to be, it's hard to say. I've seen projections anywhere around 15%. I've seen 20%. I'm not going to predict what it's actually going to be, but knowing that at 3.5% unemployment in February, we were actually looking at about 5.7 million people unemployed, we can imagine once we get data for what's actually happened now in the official numbers, unemployment is going to take a significant and sudden pop in the next couple of months as a result of this. So what does it mean in terms of GDP? One of the reasons actually I was pushing to have this webinar be a little bit later in the month is I was actually trying to let some data come in. And in fact, we actually did get the advanced GDP estimates for the first quarter of this year. They literally just got posted yesterday morning by the Bureau of Economic Analysis. So the key takeaway right now is basically GDP in Q1, based on this initial estimate, which is subject to revisions, fell by 4.8% at an annualized rate. Now, what I want to do here is just talk about what some of the data underneath the hood said. So what you're looking at on the left is just comparing the GDP numbers from the last quarter of 2019 to the first quarter of 2020. Now, you see we grew at 2.1% in 2019 annualized on Q4, and then we dropped it at 4.8% in 2020 Q1. Now, I'm breaking out here the four major components of GDP: consumption, investment, net exports, and government spending. And what you're looking at is the contributions of these areas to that negative 4.8% number. What you need to take away from looking at this is net exports and government were basically positive in terms of Q1, but that consumption and investment was negative, and consumption was really the big thing that was weighing on the first quarter. Now, it's important to note, Q1 actually had a pretty good January, a pretty good February, and what we're capturing is actually what's happening sort of in March when we started to put stay-at-home orders in place and some of the lockdown measures took effect. And that was, the last 2-3 weeks of March, not even the entire month in most cases. So what do we know underneath the hood of this? Well, if we take that consumption piece and break out what are the things that were driving the consumption component, economists generally look at 3 different categories in consumption: non-durable goods spending, durable goods spending, and services. Non-durable goods spending was actually up in terms of its contribution here. And that's not overly surprising because even in March, while a lot of the economy was pulling back, even in March, we had people still running the store, stocking up on a lot of non-durable goods. They were buying toilet paper, they were buying, lots of meat, whatever their purchasing was. So we actually still saw a positive effect on non-durable goods, but we saw the durable goods sector take a bit of a hit, which is not too surprising. I mean, people aren't going out and buying, expensive washers, dryers, cars, et cetera right now. So we saw the fall in durable goods, but the biggest hit was obviously services looking at this picture, which again, if you think about what stay-at-home orders are doing, they're saying, don't go out to restaurants. That's in the service sector. Don't go fly on a plane. All these things were heavy service-based components. So the biggest thing, I think the big takeaway right now is the stay-at-home orders, where we're basically stepping back from all those different service-oriented activities, is what's really driving the fall we see in the Q1 advanced estimate for GDP. One interesting thing that I don't know if everybody would have picked up ahead of time in the data is actually, if you look within the services component in particular, of that 4.99, actually about 2.25 of it was driven by a fall in healthcare expenditures of all things, which is a very odd thing. I think most people wouldn't predict that in a pandemic situation. You would see a pullback on healthcare spending. But the current working theory right now is what a lot of people are doing is they're stepping back from any kind of elective procedure, and they're avoiding the sort of hospitals and that as much as they possibly can right now, which is showing up in the data already. So it'll be interesting in Q2 how that plays out. So what are we thinking for Q2? I am not going to give you any kind of personal forecast. I wouldn't dare do that on something that's going to be recorded, to be honest with you. But what I will say is the following. When you actually look at, there's all kinds of forecasts out there, but I want to highlight one particular thing. I'm going to show you a snapshot of data from the Wall Street Journal's Economic Forecasting Survey. So they do this monthly. They have 50, 60, 70 economic professional forecasters throw in what they think is going to happen to a variety of metrics. What I'm showing you here on the left is what it looked like in April of last year, how they forecasted the second quarter last year. So each one of those dots represents an individual forecast. And what I want to highlight here is the spread, the range of what that forecast looks like. So last year, the range was between GDP growing in Q2 at a rate of 1.5% to, a little over 3.5%. So there's about a 2 percentage point range in the size of those estimates. When you look at the survey right now that just came out for April of 2020, where they're forecasting for Q2 2019, this is what the spread looks like. Now, the dots don't look that different because, frankly, I put them on the same graph initially, and you can't even see the April 2019 data because the range of the forecast is literally 50 percentage points. So there's one really optimistic forecaster that thought there wouldn't be very much effect on GDP, kind of a flat growth. And then there was a couple of forecasters very pessimistic talking about a 50% drop in terms of the annualized GDP number. The range here is significant, which really stresses one particular thing that I want to highlight is there's a tremendous amount of uncertainty. We don't really understand everything that's happening right now, both from data, what we're understanding from the health side, but then the actual economic ramifications. Now, there is one thing I want to highlight right now. I'll throw out there that for what it's worth, the average annualized growth forecast in this was about a 25.3% fall in GDP for Q2. This is the point where I have to do my public service announcement. You know, if I had advanced graphics, I would do like the more you know thing coming up here. But I have to stress that when we hear GDP numbers, they're often reported as annualized growth numbers. So they don't actually reflect the change from in this case, if we have a negative 25.3%, that doesn't mean that GDP fell by 25% from Q1 to Q2. Basically, the way that they calculate these numbers is they take the actual rate at which it falls from Q1 to Q2, and they say, what if this happened for the next 4 quarters, what would GDP look like? So essentially, when you see a number like it fell by 25%, to get a sense for what really happened, you would divide it by 4 because there's 4 quarters. And really, you're looking at more, if we get a negative 25% fall, you're looking at more like, 6.3, 6.4% decrease quarter over quarter. So if we get a number, let's say a number comes out and it's a 40% drop in GDP in Q2, that doesn't mean we literally lost 40% of GDP. It means we really only lost 10% for that quarter. So please pay attention when these numbers come out. How are they being reported? If they say annualized growth, make sure you're paying attention because that might cause some panic scenarios if you're not understanding exactly what that number says. So just pay attention to that. So those are a couple comments on some of the indicators. Now I want to just highlight policy response. There was a lot of questions that came in about this. I'm going to touch on just a couple of high-level things, and I'm thankful that Rafia already did a little bit of work for me in her presentation, teeing up a little bit of the Fed activity, but I want to highlight a couple of things that are just worth mentioning. The short answer, and this is not my favorite slide, but I don't know how else to possibly show you all of the things the Fed is doing, and if this deck is distributed afterwards, you can have some context if you want to dig into it. Essentially, as Rafia alluded to, the Fed really has been pulling out the playbook they used in the financial crisis. I mean, they did a lot of the standard conventional things they do. They dropped interest rates. They're trying to make it easier for banks to borrow directly from the Federal Reserve with a discount rate. They're even lowering some regulatory reserve requirements. And then the big thing that they're doing, of course, is the asset purchasing. So that's where they're basically trying to buy assets to get a bunch of liquidity into the marketplace. So if you look on the right-hand side there, asset purchases and lending to financial firms and markets is something that they did very heavily in the financial crisis, which makes sense because it was indeed a financial crisis. So they were targeting those areas to get as much liquidity into those markets as they possibly can. The thing that I want to focus on and just mention for our conversation here is what are some things that are really, really new that they didn't actually necessarily do in the financial crisis. And a lot of this is focused on how do we get liquidity to all those other parts of the economy that are not just in the financial area. So there's been a lot of programs designed to lend to non-financial firms. So there's been sort of different tiers of this targeting larger firms in particular. So some of that is buying up corporate debt, which Rafi had mentioned. Some of the really new things, though, are programs designed to assist small and mid-sized firms. So the Main Street New Loan Facility, Main Street Expanded Loan Facility, and even the Paycheck Protection Program Liquidity Facility. These are all things the Fed created to basically help get more funding to banks to distribute loans to these different pockets of businesses in the economy. And even the Paycheck Protection Program, which came under the CARES Act, a lot of it is actually being supported from the Federal Reserve perspective and making sure there's some liquidity there. And then again, mentioning lending to state and local government was not something they focused on heavily in the financial crisis, but doing that now is something they're looking at, especially in the context of trying to get resources to help with the pandemic. So what are some of the potential ramifications of this? There's going to be economists studying this for years, no doubt about it. I'm just going to tell you one thing to pay attention to sort of get a sense for the magnitude of this. So one thing we can look at is the Federal Reserve balance sheet, specifically the assets. So what have Fed assets been doing? So the picture on the left shows you the total Federal Reserve assets. Now I want to point out that prior to the financial crisis, 2006, 2007, they had about $1 trillion in assets on their balance sheet. In response to the financial crisis, they did a series of programs, quantitative easing, where they were buying up a bunch of things from the marketplace. And that's where you see those yellow lines followed by big jumps in their balance sheet, when the Fed was basically buying up different types of assets to exchange liquidity into the market. Now, what we see is they moved from about 1 trillion before the crisis to about, a little over 4.5 trillion by about 2015. So they moved from 1 trillion to 4 trillion in the financial crisis. And that took, from 2007, 8, to 2015 to get there. What we notice is the Federal Reserve took some steps in 2018, 2019 to start to reduce the size of their balance sheet. And what we notice is coming into what's happening right now, there's the huge pop at the end at that last yellow line. That is basically what they're doing right now. And you can see that last line there in 2020 at about $4 trillion-ish, give or take, in assets, and it quickly jumped to $6.5 trillion. And that was basically in the span of about 2 months. So one way to look at it, and this is what I'm highlighting on the right there, is the Federal Reserve assets have literally grown by about 58% in 2 months just to support the economy right now. So Jerome Powell, the Federal Reserve Chair, has come out and basically said, we are here to support the economy as best as we can, as long as we need to. That's the good, I guess the positive news is they want to support the economy as best they can. The downside of this and the longer question is, after all the dust settles, and once we get past this current situation, what's the ramifications on the Federal Reserve in terms of winding this down, in terms of monetizing debt? That's a much larger conversation than unfortunately I can have in the 5 minutes I have to talk about these things right now. But that's one way you can kind of track a little bit about the size of what the Federal Reserve is doing. So fiscal policy side, again, the big news here was pretty much the CARES Act, which was passed to support the economy, about a $2 trillion bill. Here's a quick snapshot of the allocation. The idea was to try and get funding to all different pockets in the economy. The biggest component in there was the amount going to individuals. That was the economic impact payments that a lot of us may have received or will be receiving soon. And then there's sort of the laundry list of funding going to big corporations, small businesses, and there's a bunch of things in there, all the way down to the safety net at the bottom of $26 billion. I'm convinced the safety net of $26 billion literally is there just to round this thing to $2 trillion because it makes it easier to talk about. The other thing I would add to what happened here is they just passed, it was last week, an additional $480 billion in secondary stimulus to this to basically help support a lot of the small business lending stuff to get more funding into those markets. So all in, about $2.5 trillion, give or take, has been funded right now out of the fiscal policy side of this. So the big question, of course, is what is the debt deficit ramification of this? And this is probably one of the scarier parts and depressing parts of the conversation today. What is this fiscal policy fallout? Well, the Congressional Budget Office, whose job it is to basically look at the budget, did recently take a look at some deficit projections and some debt projections. So what you're looking at here on the graph on the left is 2020 and 2021 projections. The gray box there shows coming into March, what were they looking at in terms of how big the deficit was going to be for the government. In March 2020, coming into it, they were anticipating, based on the current government budget that was passed, based on current government spending, we'd be running about a $1.1 trillion deficit coming into this fiscal year anyway for the government. As a result of what's happened with these programs, right now they're projecting it more to be about $3.7 trillion. So that's a significant increase. And just to give you maybe some context on that, the worst deficit we ran related to the financial crisis was in 2009, where the government ran a $1.4 trillion deficit in our worst year. So they spent $1.4 trillion more dollars than we brought in taxes. So this is a sizable jump from what we saw in the financial crisis, which obviously is concerning news when you think about it from a debt perspective. So the question becomes, well, what are the ramifications from the debt perspective? So the deficit is basically what happens each year. And that deficit accumulates into the debt. So what you're looking at on the right are the federal debt projections based on what the CBO was looking at. These are framed in the context of how much debt is there relative to GDP. Again, the gray bars are showing their projections coming into this prior to the crisis unfolding. And they were looking at, an 81% debt to GDP ratio in 2020. So if GDP is 21, 22, 20, 23 trillion, you're looking at our debt is 81% of that size. That is now revised up to about 101% estimate right now based on what they've gone through. And I will put a caveat, depending on how you define debt. The CBO does not include any debt we owe ourselves. So if there's debt to Social Security or something like that, that's actually not included in this number as a matter of context. So these numbers are sort of definitely the dismal social scientist part of my conversation today. The thing I will add, and this is something that was sort of concerning even before the situation happened, we ran the last fiscal year when we had, longest expansion U.S. history we've had, we ran basically just shy of a $1 trillion deficit, $984 billion last fiscal year before any of this happened. So we actually weren't on the best footing to begin with going into this from a fiscal standpoint. And the one concern, and anybody that has any debt of any kind or borrowed money ever knows this, the more debt you take on, the more you have to pay off. So one of the things coming into this is we've seen sizable increases in how much interest the government has to pay to service the existing debt. So if we're taking on more, something that people are going to be watching over the coming years is how much more do we have to put into servicing the existing debt that we have and the debt we're adding on as a result of this, because that's more money we have to allocate each year to do so. So that is definitely one of the depressing parts of my conversation. And again, there's webinars we could do just on this topic, no doubt, for a long time. So last thing I want to touch on a little bit is the regional perspective. A lot of people on this call are likely interested in this. I'll say a couple of comments, but preface this by saying it's difficult to say a lot right now because regional data is pretty much the slowest for us to get. So I thought I would touch on two particular things that might be things to think about. The first is there was a recent analysis done out of the Brookings Institute, and they basically did, and this is kind of a projection-based thing to an extent, is they, using a research note out of Moody Analytics, they looked at what industries are likely to be at high risk given stay-at-home orders and what's been happening in terms of the lockdown situation. And the Moody's article concluded that leisure, hospitality, employment services, mining, travel arrangements, transportation, all areas that might feel a little bit more of the pain of what's happening as a result of this crisis. So what they did then is they looked at all the major metropolitan areas in the country, and they figured out what percentage of jobs fall in each one of those categories, and then basically concluded these are the areas that are basically most vulnerable to these potential types of shocks. So what you're looking at in this map is the average of all of the metropolitan areas in those particular states of jobs in these 5 sectors. And the highlights, if you look at this in terms of the darkest states, are probably Nevada and New Jersey pop out the most. And there's an obvious reason why, if you think about it. Here's the top 5 metro areas that are likely to be impacted. And this is all based on the share of jobs in those sectors. So you got 2 areas from Texas here, Midland and Odessa. And then you have area in Hawaii, Atlantic City, and Las Vegas. So what you're basically seeing is you see a lot of issues in terms of energy markets, which is the Midland and Odessa part coming up. I'm sure Matt can say lots about that following up after me. And then you see the tourism hospitality areas are particular hotspots. Now, the reason I'm mentioning this is I wanted to bring it back to Wisconsin a little bit. And where does Wisconsin fall in these most at-risk categories? Here's a list of all the major metropolitan areas in Wisconsin that were included in the data set. And what you're seeing there is the percentage of metro jobs in those spaces. So Janesville, Beloit area had the most jobs in these categories, 15.5%, and Oshkosh, Neenah had the least, 11.6%. So note, the spread here isn't massive. We're not talking about 10% to 40%. What I can say is ranking-wise, the one optimistic thing I can say, and I use that word very lightly, is of the 382 areas that were analyzed across the country for metropolitan areas, Wisconsin actually falls largely in the latter half of those metropolitan areas. So the one bright spot maybe is we're a little bit less vulnerable as it pertains to these specific sectors. In many ways, obviously, everyone is vulnerable across the economy. And specifically, we can look a little bit more narrow focused on what Wisconsin businesses are currently experiencing. Now, the nice thing about what's happening at University of Wisconsin-Oshkosh is they're currently doing a survey out of their Center for Customized Research and Services, and they're basically tapping all the businesses in the state as best they can to get some information on what they're seeing on the ground in terms of COVID-19. So they ran the first round of the survey the first week of April. They had 2,538 businesses participate. I had the pleasure of having a conversation with Jeff Soski, their director, and he agreed to let me share some of the results, although I will definitely encourage you to look up more information because there's a lot more I'm going to present here. 2 notable highlights that he suggested we talk about. First, and this is the stat that scares me a little bit for sure as an economist, is that 33% of businesses responding to this said they do not expect to survive more than 3 months under the current conditions. So if we were going to continue along with the exact situation we have here, 1/3 of the businesses responded said they don't think they would be viably around or could last that long without any kind of substantial change. That is a number that obviously is probably similar across multiple states across the country, but that really is one of the reasons why I think you've seen a lot of policy response has been targeted towards helping small, mid-sized businesses in particular, because that's a very real challenge that a lot of businesses are facing right now. The second stat that's worth mentioning is that 42% of the businesses reported that they know they're being impacted by what's happening, but they don't exactly know how they're being impacted. And I think that's a stat that really highlights the massive amount of uncertainty that we're seeing as it pertains to this situation. There's so many unknowns, there's so much uncertainty that businesses aren't even really sure exactly what should I be doing differently here. And that's the piece that is probably my biggest theme, is there's tremendous amount of uncertainty in the marketplace right now, which is going to carry over into everything we do moving forward. I will just give a quick shameless plug. Please, please, please check out the data at the UWO Center for Customized Research and Services. Specifically, if you're a business owner on this call, or your business is not participating, please, they're doing another survey in May 4th. Please look it up and participate. The more data we can get from businesses about what's happening, the better we can say about, what things are happening on the ground in more real time than some of the economic data we're going to get with a lag. So I kind of did a quick crash course in a lot of different things. I'm going to wrap up a couple quick takeaways. First thing to note, economic data lags by nature. So we know the next couple of months of data are not going to be pretty, and they're going to get much worse than anything we've seen so far, specifically in terms of the official statistics. Be prepared for that. Expect double-digit unemployment numbers. That probably will not be a surprise. And expect double-digit decreases in GDP. That would not be a surprise either. The monetary and fiscal policy response to this has been significant. And I will say that cleaning up after this crisis is going to take some time, but the focal point right now has been, and to an extent needs to be, how do we get through this in the short run first and worry about that part afterward. At least that's the approach at the moment. And the entire economy is going to suffer from this. Wisconsin might be reasonably positioned from the very specific vulnerable jobs perspective. Of course, there are many, many industries that are feeling this in all different kinds of ways, and we still have many, many challenges on the horizon. I have a couple comments to make about the recovery side, but I'll save them for the end of the talk. I think right now I'll pass it over to Matt, and I will let him dig a little bit into what's happening in the oil markets, which is an exciting conversation.
Thanks, Mark. And it's helpful to have updates on GDP and the consumption side of that GDP equation, because I'm going to get into addressing both the freight and the fuel markets in this segment of the presentation. And you can see why some of that underlying data and that GDP share has shaken out the way it has. And so Mark had a shameless plug for another center of research. I'm also going to be shameless about plugging a St. Norbert College Center of Research, because as it works out, the Center for Business and Economic Analysis had a hand in some of the analysis and data insights that sit underneath some of the freight research that I'm going to share with you now. And so just like Mark had talked about the value of forecasts and how he's probably torn it up some this year, we've certainly torn up our beginning of year forecast. And so if we go to the next slide, like so many, when it comes to the freight and fuel markets, we entered 2020 thinking that we would see a global growth improvement from 2019, that across both advanced and emerging economies, we would see stable growth in places like the United States, we'd see improvements in places like China, and of course, those expectations are long gone. And because of those growth forecasts, we also looked at an energy market that we thought would repeat performance from previous years, like 2018, 2019. And here I'm sharing kind of a Bloomberg aggregate US West Texas Intermediate benchmark for crude oil, and its forecasted price on January 1st was $56.68 per barrel. And wow, have we come a long way from there. But what I'd like to do in the rest of the presentation is address what we've experienced in these markets, and also give some insights into the trends that are continuing as this shock progresses forward. And so to begin this shock chronologically, if we think back all the way to the end of January in China, and when the coronavirus really emerged in Wuhan and Hubei province, it began with a manufacturing disruption for a lot of international supply chains. And the freight story that I'm talking about is very US centric. And here I'm showing a couple of charts that first shows containers and the number of containers as they exit Chinese ports, that's shown on top. And then in the bottom, I'm showing containers as they're entering the major West Coast US ports of Los Angeles and Long Beach. And so if we think back to that initial disruption in China, right around the Chinese New Year, manufacturers had no choice but to shut down for containment. This was particularly eventful for supply chains around the automotive industry, for technology manufacturers. And in the US, we really didn't feel the brunt of this for 15 to 18 days, because that's the amount of time it takes for imports to hit our shores. And so 15 to 18 days later, we start to see the lagged impact in the ports of Los Angeles and Long Beach. And it's worth calling out that in the month of March, those imports were 30% below year-ago numbers. What's unique about the experience that's continued is that this shock has changed from a supply-side shock in supply chains into a demand-side shock. And so while we thought that the manufacturing letdown in China would have reestablished port volumes, now that we've passed this time frame of influence, it hasn't. That port volumes remain down 10 to 20%. That's our continuing expectation heading into summer. And if we go to the next slide, that's because we've had the impact of the virus domestically here in the United States, and it's certainly changed consumption patterns around non-durable. And here, really, I'm specifically speaking to non-discretionary goods or the must-have, the household supplies, food and beverage products. And the story has been quite different for durable goods. So if we start with non-durables, the percentage change in shipments that's called out in light blue, you can see took off in March. And that's because we had community spread of COVID-19 here in the United States. We're in safer at home orders, and we've stocked up as consumers. You also noticed as we have gone into April that much of this has come out of the market, that a lot of those non-durable shipment volumes are returning back to normal. On the durable side, we saw a steep plummet in durable goods volume. So even though those durable goods manufacturers like the automotive industry had to experience the lag of their products coming to the US to begin the year due to the Chinese disruption, they haven't been able to sell them. Consumers have tightened up around the purchase of durable goods because there's a lot of headwinds, like Mark talked about, in consumer confidence and certainly in consumer behavior, as well as the labor market. Until this really becomes healthy again, we're going to continue to see these headwinds of durable goods. I should state that this is all internal breakthrough data, but it's pretty robust. We work with about 60,000 truckload shipments a day internally. And so the neat part of that experience is we can see this data in near real time, and these markets play out in near real time. Regionally, as we move to the next slide, we have experienced a progression that makes sense when we think about how we've had cases of community spread. And I realize by COVID-19 timeline standards, the heat map at left is ancient. April 17th, a lot has changed from then, but it does call out kind of where community spread started, especially in that middle Atlantic region, of course, New York, New Jersey, as well as along the Pacific coast. And that showed up heavily in our freight data through the month of March, that those regions were up year over year 25%. Collectively, the United States was up 15%, and month to month, the improvement from February was 14%. But again, this is in relationship to a surge. For those manufacturers who are moving essential products, this felt like a second holiday season, but there's an imbalanced experience, because if you're a durable manufacturer, this felt nothing like the holiday season, unfortunately. And all of this had some profound implications for the commodities markets. And so it's here that I'll transition from commentary about the broader freight markets and into energy and other commodities that are closer to home on the next slide. And so I'd like to start by speaking about some commodities that are really important to the upper Midwest, especially Wisconsin. Here in this chart, I'm showing the percentage change in price of these commodities year to date. You can see these include commodities like milk, called out in the gray, corn in the gold, and then lean hogs and live cattle as they're relevant to our meat processing and manufacturing sites here in Wisconsin, the upper Midwest. And of course, we know about the outbreaks that have been happening there recently. But all of these commodities have been disrupted. Milk has lost consumption in schools, in restaurants, for specialty cheeses. There is no March Madness, no cheese plates to be found in our homes among guests, that's for sure. When it comes to Meat packing, we're aware of the outbreaks recently, and that moves to the upstream supply chain. So they're nowhere to move lean hogs and live cattle, and so their prices fall. When it comes to corn, it's not being used in ethanol because we're not consuming gasoline if we're safer at home. And this, of course, gasoline demand plays heavily into why we see that dark blue line as volatile and as low as it is in this chart, and why crude oil prices have plummeted. Far and away, energy commodities across the board have been hardest hit, and that is certainly shown on this slide. Even going to an extremely unusual place of nearly negative $38 per barrel for crude oil. And the question arises, is that even possible? Why does that happen? And so I only have about 30 seconds to explain it. And last week I was on, or a couple of weeks ago, I was on webcast talking about this for an hour or more. But I'd like to simplify it, and it's an imperfect simplification by saying it's kind of like a game of hot potato. In March, 75% of our storage for crude oil in the United States was already full. So when we get to April and are trying to sell crude oil for May, producers have nowhere to store it. Traders don't want it because there's no demand for it, but somebody ultimately gets stuck with it. And so producers needed to incentivize traders massively to take it. And that incentive was that producers lost $37.63 per barrel. And so that's how it happens. Nobody wants it. And to help explain that and to elaborate on this conversation, I'd also like to call it the difference between what we're seeing in gasoline and diesel markets. And I'll do that on this slide and use Quick Trip's sign here for reference. So why is it that on Monday, when my family walked past this sign, diesel retail prices, I should say, are 90 cents above the unleaded gasoline retail price? And this is because refined products are being treated very different in the market because their relative demand is so different. Gasoline demand, as I'll show in just a moment, has plummeted, while diesel is still being used and consumed to move those essential products. I should add one more piece of knowledge on this sign, that if you're planning for virtual happy hours this weekend, it turns out Quick Trip has the lowest legal beer prices. I'm sure other fuel stations do too. Didn't realize that was on the sign at the moment this was taken. And if we go into the next, thanks. Just in talking about that difference throughout the refined barrel and the difference in products supplied, the value of crude oil comes from the refiners who are demanding it. And so if there's no demand for the products made at the refinery, which are split out in the stack bar at right, then refiners don't value crude oil. And on average, about 40% of every barrel of crude oil in the United States becomes gasoline. That's the relative slice that's made as crude oil works its way through distillation units and other parts of the massive chemistry sets that are refineries. Diesel, on the other hand, is only about a quarter of all the gallons. And so there's a huge imbalance here. So if demand plummets dramatically for gasoline because we're staying at home, but heavy duty trucks, other heavy duty modes of transportation like rail or even marine transport need that diesel fuel to move goods to market, then diesel's value remains much higher. And so that's what we're seeing play out between these couple of price points. I'd also like to elaborate on this in terms of the demand picture, if we go to the next slide, of how historic of a shift in demand we're really experiencing. Today, well, I can't really say today anymore, but at the beginning of the year, we were living in about a 100 million barrel per day oil market. In the month of April, demand internationally will fall to about 75 million barrels per day by our best estimate of numbers that we've seen come in. Here in the United States, gasoline demand has almost been cut in half in recent figures, jet fuel down even further, and quite frankly is down even more than that on an international scale, as international flights and many domestic flights have been halted and certainly don't have their previous volumes. On the diesel side, called out in the light blue on this chart, we're at a level to the lowest product supplied since 2016, but we're not at the kind of lowest levels in decades that gasoline and jet fuel have fallen to. Really unprecedented demand shock. And so ultimately, this creates a massive imbalance across the energy product spectrum. And that this is something that can only be worked through as demand returns, as economies reopen, like presumably we're going to see begin in May, and as well as internationally. But there are a lot of speculation and questions about what does this mean to the future of supply transport fuels, at least the conventional ones. Have we seen peak gasoline demand? Does this shock set that high point? And so this will be an interesting narrative to watch, not only in the near term, in the months ahead, as the market looks to correct the supply side of the equation to balance with this massive demand loss, but for years to come. And finally, I'd like to wrap up with just some key takeaway thoughts. And when it comes to supply chains, kind of a precursor to COVID-19 that we're getting supply chains to think about their agility was the tariff environment. And unfortunately for supply chains, the COVID-19 shock has continued disruption in the market and forced shippers and their carrier partners who are moving their freight to become increasingly agile. And those that are able to leverage their internal performance metrics and really determine which relationships are most valuable in their movement of freight are going to be rewarded regardless of business cycle. When it comes to the energy market, the unprecedented demand shock that sees us safer at home and broadcasting webcasts live from our office basements has left the market or our basement offices, I should say, has left the market steeply imbalanced. We're going to see supply side corrections come into the market. Mark talked about Odessa and Midland, Texas, being among the most vulnerable metropolitan areas in terms of job loss. And that's because these areas are home to the US's Permian Basin. This is fracking and shale oil production central in the United States. And much of this oil makes its way to international markets through Houston and Corpus Christi. Recently, Mexico has halted its import of crude oil and refined products from the United States. So this adds to the US's problems of having an imbalanced market. And so we'll see some heavy changes on the supply side, likely some consolidation of the industry and bankruptcies, unfortunately, but we are seeing US oil supply come down rapidly. In February, we reached our all-time high of 13.1 million barrels. We're already down to 12.1 million barrels per day now at the end of April, and that will continue to fall quite rapidly. And finally, just in general, it's really for what's next, it's really these supply side adjustments that will be most in tune to both when it comes to movement of freight and broader energy markets. I think that's what to look for next. How does this adjust to combat the demand shock? With that, I'd like to say thank you, and Mark will rejoin for some comments.
So maybe just to do a couple of closing remarks here across all of our presenters. Maybe I'll start off with my my closing comments. I didn't spend a lot of time talking about the recovery aspect in my initial comments. I think there's a whole host of conversations happening right there. The one thing that you'll hear often talked about in that conversation is, what letter are we talking about? You'll hear the V, the W, the U, the L. What's the shape of GDP in terms of how it's going to recover? And the thing I'll say about that is, I think a lot of people are optimistic initially that maybe this is a V-shaped recovery, partially because a lot of our initial challenges were because, the government mandated stay-at-home orders, and there was this kind of a sudden stop, if you will, to all of the economic activity. The optimism there would be, suppose from a health perspective, we find some kind of vaccine, really quick, and then we can come back to normal. That probably is not a high likelihood scenario at this point for what we're hearing from the health community, which leads more of the U-type recovery conversation, I think, is what I'm hearing a little bit more of. The one comment I'm going to say, and nobody knows the answer to this question right now because there's way too much uncertainty. The one thing I will say that I think for us to finally get back to some sort of normal level, the key thing that has to be overcome is how do we get consumers to feel comfortable, to feel safe to go out and proceed like they have before in the past. Even when you looked at some of the behavior of when some of these sectors were feeling some of the pain of the stay-at-home orders, a lot of the activity was actually falling before the stay-at-home orders even took place. The hurdle to overcome to get back to some normalcy is how do we get regular consumers to start to feel like they can behave like they did before. And in many regards, a lot of this is going to come down to not so much, flipping a switch to reopen the economy per se, but a lot of it comes down to the health and science community to work through providing some solutions that we can work forward to make us feel safer as consumers to resume our normal behavior. And I don't think an economist can answer that question, but what I think economists will say is a lot of this depends on how do we shape those consumer expectations. And that's going to be, in my perspective, the key thing that's going to drive the recovery is what has to happen to get those consumers to feel comfortable to resume their behavior again. And I can maybe pop it over to Rafia if you want to make any closing remarks on your end, Rafia.
Sure. Yeah, I think the closing remark that I would make that I made, at the end of my segment was just understanding that the market tends to be a leading indicator of the economy. So while there's a lot of negative news, as Mark has discussed, that's already out there and potential more negative news to come, we don't know how much of that is already priced in. And obviously, if there's an unexpected negative health outcome related thing that comes up, yes, the market could go down further before, we have an eventual recovery. And so really recognizing how difficult it is to predict these things and how, you'll hear market commentators, pundits come on, but really nobody has a crystal ball to be able to predict what's going to happen. And so I'll hand it over to Matt for his final comments.
Thanks, Rafia. I certainly agree with the statement that no one has a crystal ball. In energy markets, that's very much the case. Markets are continuing to move on tweets, of course. They're moving each time that OPEC, the Organization for Petroleum Exporting Countries, and others announce cuts. But the market's very out of balance. We do know that. And in the near term, it seems there'll be lower prices in the energy market. Something that we're watching for, though, in terms of guidance on longer term price, is there the chance that there's an overcorrection, whether through bankruptcies, whether through turmoil among nations who rely on oil as a principal portion of their budgets? Is there other disruptions that in the medium to longer term have an impact on prices? And ultimately, we think the next year to 2 year time horizon that we typically forecast for clients, prices will be very volatile. And with that, give the conversation back to Mark or Dan.
Well, I just want to extend my gratitude for all the thoughtful commentary from all of our presenters. So Matt, Rafia, and Mark, thank you very, very much. Obviously, we're running a little bit long, so I think we will use the questions that were submitted and huddle afterwards to see what future webinars we might be able to present rather than try to address those right now. But on behalf of the Schneider School of Business and Economics and the Office of Alumni and Parent Relations at St. Norbert College, I want to again say thank you to everyone who tuned in today. I hope you found the information useful and insightful as we look forward through this unprecedented time. Reminder again that you can expect an email for those of you who pre-registered, and we'll encourage you to fill out that survey so that we can get you a copy of the slide deck. And if you have other questions, please put that in your survey response, and we will try to be responsive through future seminars or other fashions. Mark, you have anything? All right.
Just to reiterate my thank you again to Matt, Rafia, Breakthrough, Wipfli for helping to make this event possible today. And Dan, thank you for taking the time to moderate.